The more basic reason for the evolution of financial centers is obviously to be found in the relativity of money. This is because, on the one hand, money expresses only value relationships between commodities, while on the other the value of every definite quantity of money cannot be as directly ascertained as can that of any other commodity. It has significance only in comparison with the total amount that is offered. Therefore, the maximum concentration of money at one point, the continuous competition of huge amounts, the balancing of a major part of supply and demand as such, will lead to the more accurate determination of its value and to its greater utilization. A bushel of grain has a particular importance at any one place, no matter how isolated and regardless of its money value. A certain quantity of money, however, is important only in relation to other values. Hence, in order to attain a stable and just valuation, money has to be confronted with as many other values as possible. This is the reason why not only everything presses for gold, men as well as things, but also why money itself presses for everything. It seeks to come together with other money, with all possible kinds of values and their owners. The same interrelationship operates in the opposite direction. The convergence of large numbers of people brings about a particularly strong need for money. In Germany, one of the main demands for money arose out of annual fairs organized by local lords in order to profit from the exchange of currency and the tax on goods. Through this enforced concentration of commercial transactions at a single point in a larger territory, the inclination to buy and sell was greatly increased and the need for money thereby first became a general necessity. Wherever increasingly large numbers of people come together, money becomes relatively that much more in demand. Because of its indifferent nature, money is the most suitable bridge and means of communication between many and diverse people. The more people there are, the fewer are the spheres within which they can base their transactions except through monetary interests. The mobilization of values. All this illustrates to what great extent money symbolizes acceleration in the pace of life and how it measures itself against the number and diversity of inflowing and alternating impressions and stimuli. The tendency of money to converge and to accumulate, if not in the hands of individuals then in fixed local centers, to bring together the interests of and thereby individuals themselves, to establish contact between them on a common ground and thus, as determined by the form of value that money represents, to concentrate the most diverse elements in the smallest possible space. In short, this tendency and capacity of money has the psychological effect of enhancing the variety and richness of life, that is, of increasing the pace of life. It has already been emphasized elsewhere that the modern concept of time, as a value determined by its usefulness and scarcity, first became accepted with the growth of capitalism in Germany when, during the 15th century, world trade and financial centers developed together with the quick turnover of cheap money. It was in this period that the church clocks began to strike at every quarter of an hour, and Sebastian Frank, who was the first to recognize the revolutionary significance of money even though in a most pessimistic manner, first called time an expensive commodity. The most characteristic symbol of all these correlations is the stock exchange. Economic values and interests are here completely reduced to their monetary expression. The stock exchange and its representatives have achieved the closest possible local assembly in order to carry out the clearance, distribution and balancing of money in the quickest manner possible. This twofold condensation of values into the money form and of monetary transactions into the form of the stock exchange makes it possible for values to be rushed through the greatest number of hands in the shortest possible time. The New York Stock Exchange, for instance, has a turnover every year that is 5 times the amount of the cotton harvest through speculation in cotton, and even in 1887 50 times the total yearly production of oil was sold there. The frequency of the turnover increases with fluctuations in the quoted price of a particular value. Indeed, the fluctuations in the rate of exchange was the reason why regular stock exchange dealings in royal promissory notes, Königsbriefen, developed at all in the 16th century. For these notes, which reflected the changing credit status of, for instance, the French crown, provided a completely different inducement to buying and selling than had previously existed with stable values. Changes in valuation are greatly increased and even often brought about by the flexible quality of money to express them directly. And this is the cause as well as the effect of the fact that the stock exchange is the center of monetary transactions. It is, as it were, the geometrical focal point of all these changes in valuation, and at the same time the place of greatest excitement in economic life. Its sanguine choleric oscillations between optimism and pessimism, its nervous reaction to ponderable and imponderable matters, the swiftness with which every factor affecting the situation is grasped and forgotten again, all this represents an extreme acceleration in the pace of life, a feverish commotion and compression of its fluctuations, in which the specific influence of money upon the course of psychological life becomes most clearly discernible. Finally, the relative speed of circulation of money in relation to all other objects must immediately increase the general pace of life wherever money becomes the general center of interest. The roundness of coins which makes them roll symbolizes the rhythm of the movement that money imparts to transactions. Even where coins originally possessed corners, their constant use must have smoothed the corners and rounded them off. Physical necessity has thus provided the most useful form of instrument for the intensity of transactions. For centuries in the countries bordering on the Nile there even existed globular money composed of glass, wood or agate. The differences in the material used suggests that its form was the reason for its popularity. It is no coincidence that the principle of rounding off is applied with reference to large sums of money, since this principle corresponds to the expanding money economy. Rounding off is a relatively modern term. The most primitive form of checks payable to the English treasury were tallies for any irregular amount, and they frequently circulated as money. Only in the 18th century were they replaced by endorsable paper bills which represented rounded-off amounts from £5 upwards. It is surprising how little attention was formerly paid to rounding off, even for large amounts of money. That the Fuggers in 1530 agreed to pay 275,333 florins and 20 crowns to the Emperor Ferdinand, and that Emperor Maximilian II in 1577 owed them 220,674 florins, are not isolated cases. The development of the institution of shares followed a similar course. The joint stock of the East India Company in the Netherlands in the 17th century could be split up into any proportions that might be desired. Only the acceleration of transactions finally brought about the situation in which a fixed unit of 500 Flemish pounds became the only possible unit of ownership or share in its trade. Even today in the retail trade, monetary transactions are calculated in rounded-off amounts in places with a considerable volume of money transactions, whereas prices in more remote regions would appear to be rarely rounded off. The above-mentioned development from inconveniently large to smaller coins and money orders clearly has the same significance for the acceleration of the speed of transactions as the rounding-off process, which itself suggests a physical analogy. The need to have money in small amounts increases with the speed of transactions. In this context, it is significant that in 1844 an English banknote circulated on average for 57 days before being redeemed, whereas in 1871 it circulated for only 37 days. If one compares the velocity of circulation of landed property with that of money, then this immediately illustrates the difference in the pace of life between periods when the one or the other was the focal point of economic activity. One thinks, for example, of the character of tax payments with reference to external and internal fluctuations depending on the object on which they were levied. In Anglo-Saxon and Norman England taxes were imposed exclusively upon land ownership. During the 12th century levies were imposed on the possession of cattle. Shortly afterwards, certain portions of mobile property, the 4th, 7th and 13th parts, became taxable. The objects of taxation became more and more diverse until finally money income was made the proper basis of taxation. In so doing, taxation attains a hitherto unknown degree of flexibility and adjustability, and the result is a much greater variability and yearly fluctuation in the contribution of individuals, combined with a greater stability of the total revenue produced. The direct significance of an emphasis upon landed property or money for the pace of life may explain the great value that very conservative peoples place upon agriculture. The Chinese are convinced that only agriculture secures the peace and perpetuation of states, and perhaps for this reason they have imposed a huge tax upon the sale of land, so that most sales of land are carried out privately and without official registration. But where the acceleration of economic life that is instigated by money has asserted